Welcome back to Smart Stock Sam, the channel where we cut through the Wall Street noise and hand you institutional-level analysis without the fluff. If this is your first time here, you are in exactly the right place, and by the end of this video, you are going to understand why SanDisk Corporation, ticker SNDK, may be the single most important stock decision you make this year. Today, we are going to answer the one question that every serious investor is wrestling with right now. Is SanDisk the greatest artificial intelligence infrastructure play of the entire decade, or is this breathtaking rally secretly a ticking time bomb ready to detonate? We are going to break down the raw price action, the jaw-dropping fundamentals, the alarming insider behavior, the options market's hidden warning signal, and we will close with the exact price levels you absolutely need to know before you even think about touching this stock. So stay locked in, because this one is going to change how you look at the entire AI memory sector. Let us start with why this stock has the entire market talking. Since SanDisk spun off from Western Digital back in February of 2025, it has staged one of the most violent and relentless rallies in modern stock market history, 6,500%. Let that number breathe for a second. To put it in perspective, if you had quietly parked $10,000 into SanDisk shares at the spin-off price, you would be sitting on roughly $650,000 today. That is life-changing money generated from a company that makes the memory chips sitting inside enterprise data centers. And the reason the market has gone absolutely berserk over this name comes down to one simple, unavoidable truth. Artificial intelligence runs on data, and data has to be stored somewhere. But here is what makes this story even more gripping. The recent price action has been nothing short of terrifying, even for the most hardened traders. Just a few weeks ago, on June 5th, SanDisk was quietly trading down in the 1500s. Then something ignited. The stock ripped aggressively, eventually tagging an all-time high of $2,354.39 on June 22nd. That is a monster move in less than 3 weeks. And then, without warning, gravity showed up. The stock suffered a one-day bloodbath, collapsing over 10% in a single session, closing at $2,090.71. Billions in market capitalization evaporated in a matter of hours. Volume spiked to 15 million shares on that single down day, proving this is not a quiet, orderly market. This is a high-stakes war zone where retail traders, institutional giants, and corporate insiders are all fighting over the same shares. And right now, that battlefield has left a lot of investors completely paralyzed. So let us figure out who is right. To understand why the smart money keeps pouring into this name despite the chaos, you have to look at the fundamental engine underneath this company, and what we see there is genuinely stunning. SanDisk just reported fiscal third-quarter results that can only be described as a complete blowout. Revenue came in at $5.95 billion. Now, for context, that represents a 251% increase year over year, 251%. But the number that truly separates SanDisk from every other hardware manufacturer on the planet is not the revenue figure. It is the gross margin, 78.4%. In the hardware world, where most manufacturers are grinding out margins in the teens or low 20s, a gross margin of 78.4% is essentially unheard of. It tells you one thing louder than anything else. SanDisk has absolute, unchallenged pricing power. They are not competing on price. Their customers are paying whatever SanDisk demands because there is simply no viable alternative for enterprise-grade AI memory at this scale. That is a moat. That is the kind of competitive advantage that makes long-term investors salivate. And here is where the story gets even more interesting. For decades, the memory chip industry was considered one of the most dangerous places to invest. It was brutally cyclical. Boom, then bust, then boom again. Prices would collapse, inventories would pile up, companies would suffer catastrophic losses. But SanDisk is now claiming they have fundamentally broken that cycle, and they have done it through what they call their new business model. The idea is elegant. Instead of selling chips on the open spot market where prices are volatile and unpredictable, SanDisk has locked in the world's largest technology companies. The hyperscalers, the Microsofts, the Googles, the Amazons of the world into multi-year fixed-price supply agreements, and the result of those locked-in deals? SanDisk is currently sitting on a guaranteed contract backlog of $42 billion. $42 billion. This is the number that is driving bulls absolutely wild, because it theoretically transforms what used to be a volatile commodity chip maker into something that looks and behaves more like a utility. Predictable, recurring, contracted revenue stretching years into the future. If this model holds, the traditional playbook for valuing hardware companies is completely obsolete. But now comes the part of this video where we have to get uncomfortable. Because while the fundamental story sounds incredible on paper, something else is happening behind the curtain that every investor needs to understand before making a single move. So let me ask you this. If the business is truly this strong, if the contracts are locked in, if the margins are this spectacular, why are the people who know the business best quietly walking out the door with their money? Here is the uncomfortable reality. At the same time that institutional giants like Vanguard and BlackRock are cornering the float, and make no mistake, 1,190 institutions now hold 87.12% of the total float. The executives inside SanDisk are doing something very different. Over the last 3 months, insiders have executed $8.9 million worth of stock sales. Chief Legal Officer Bernard Scheck and Chief Technology Officer Alper Ilkbahar both recently liquidated heavy positions near these all-time highs. And the most telling detail of all? 0 insider purchases. Not one single share bought by anyone with inside knowledge of the business. They are selling into this rally with both hands, and no one on the inside is buying. Now, insider selling alone does not automatically mean disaster. Executives sell for many reasons, including diversification, tax planning, estate strategies. But when selling is this one-sided, this concentrated, and this aggressive near all-time highs, it is a data point that should stop you dead in your tracks. Now, while the insiders are exiting, the analyst community has a very different opinion. Following a blockbuster earnings report from memory peer Micron Technology, Citigroup raised their price target on SanDisk to $2,500. The highest price target on the street currently sits at an almost unbelievable $3,250. Out of 29 major analysts who cover the stock, 18 have an official buy rating. The bull case is loud, it is well-funded, and it is everywhere. But it is not unanimous. A small but growing faction of skeptics, including voices from Morgan Stanley and others, have issued targets in the $1,700 range. Their argument is simple and sobering. Artificial intelligence memory valuations have been stretched to genuinely dangerous extremes, and what we just witnessed, that brutal 10% single-day drop, might not be the end of the correction. It might be the beginning. So, who is right? To find out, we need to stop listening to the analysts and start listening to the options market, because the options market does not have a PR department. It just tells the truth. What the derivatives market is signaling right now should make every SanDisk investor's hair stand on end. The put-to-call open interest ratio is currently sitting at 3.01. For anyone newer to options, a ratio above 1 is already considered bearish, meaning more traders are betting on downside than upside. A ratio of 3 means there are 3 times as many put contracts, direct bets that the stock is going to fall, as there are call contracts. Right now, we are looking at approximately 58,000 open put contracts versus just 19,000 open call contracts. That is not a slightly cautious market. That is an options market screaming that something painful may be coming. And on top of that, implied volatility is running at 118%. When implied volatility is this elevated, it means institutional players are paying absolute top dollar to protect themselves against explosive downside moves. They are not nibbling on a little hedge. They are buying serious expensive insurance, and smart money does not buy expensive insurance unless they genuinely believe they need it. And then there is what is happening in the shadows, in the off-exchange dark pool trading, where institutions execute their largest and most sensitive positions away from the public eye. The publicly reported short interest on the lit exchanges looks relatively tame at 6.31% of the float. But when you look at the dark pool short volume ratios over recent trading sessions, they have spiked as high as 46.73%. What does that tell us? It tells us that institutional bears are hiding the real size of their short positions off the public exchanges, suppressing the price without revealing their hand. There is a coordinated institutional short thesis running underneath this stock that the simple short interest number does not capture. And that tension between the institutional longs who are diamond-handing their positions and the institutional shorts quietly piling in through dark pools is exactly what is creating this explosive whipsaw volatility. Now, let us bring it back to the question every investor cares about most. What is this stock actually worth? Valuation here is the ultimate battleground. If you analyze SanDisk through a traditional lens, the numbers look genuinely uncomfortable. The stock trades at a trailing price-to-earnings ratio of over 70. For a hardware company, that is a valuation that historically signals extreme overpricing, and value-oriented investors will tell you to run without looking back. But here is the counter-argument from the growth camp, and it is not an unreasonable one. That $42 billion fixed contract backlog means SanDisk's future revenue is largely already written. When you look at forward earnings estimates and you model in the new business model contracts, the forward valuation looks dramatically more reasonable. The real debate is not whether the stock is expensive today. It is whether the new business model truly holds or whether something unexpected breaks the thesis before those contracts pay off. And that brings us to the three metrics you must monitor if you are going to trade or invest in this name. First, watch the remaining performance obligations number in every single earnings call. That figure tells you whether those locked-in contracts are actually being maintained or quietly renegotiated away. If that number starts shrinking, the entire bull case collapses. Second, monitor global and flash spot prices. If spot prices start falling hard, it signals that global memory supply is finally catching up to artificial intelligence demand. The moment that happens, SanDisk's pricing power begins to erode, and those beautiful 78.4% gross margins start compressing. And third, keep a close eye on hyperscaler capital expenditure announcements. If Microsoft, Google, Meta, or Amazon start signaling any kind of reduction or delay in data center spending, the memory demand thesis breaks down faster than most investors can react. Those three indicators are your early warning system. Now, for the traders in the room who want to know what to actually do with this information right now, let us look at the chart. The 10% crash we just witnessed was technically necessary. Last month, SanDisk's monthly relative strength index reached a hyperextended reading of 99. That is not overbought. That is a stock running a dangerous fever, and the market had to cool it down. After the multi-day sell-off, the 14-day relative strength index has now cooled to a neutral 46.5. The momentum chasers have been flushed out, and the chart is resetting. The macro-technical structure remains entirely intact. The stock is still trading well above its 200-day moving average, sitting near $1,773, which means the long-term uptrend has not been broken. Given the extreme put ratio and the heavy dark pool short interest we discussed, SanDisk has become a prime setup candidate for a short covering squeeze or a gamma squeeze if it holds the right support levels. The high-probability bounce zone traders are watching sites between $1,860 and $1,920. Earlier this week, the stock found a hard floor at exactly $1,861.01. That is your primary support line. Below that, the 20-day moving average near $1,820 provides a secondary cushion. If the stock holds these levels, the upside targets are $2,134, followed by a retest of the all-time high area near $2,354. However, if SanDisk closes a full trading day below the 200-day moving average at $1,773, the short-term bull thesis is dead. You cut losses and walk away. No arguing with the chart. For those thinking about how to play this with options, remember that implied volatility of 118% makes buying calls extremely expensive right now. Instead, consider looking at selling cash-secured puts at the 1,820 or 1,860 strike prices. Because fear in the market is so elevated, the premiums you collect are rich and inflated. If the stock stays above your strike, you keep every dollar of that premium as profit. If it drops to your strike, you are obligated to buy the stock at a steep discount right at technical support, which is exactly where you would want to buy it anyway. Alternatively, bull put credit spreads allow you to capitalize on this inflated volatility while putting a hard ceiling on your maximum possible loss. Before we wrap up today, Smart Stock Sam wants to be completely transparent with you. Everything discussed in this video is for educational and informational purposes only and does not constitute financial advice, investment advice, or a recommendation to buy or sell any security. SanDisk is an extraordinarily high volatility stock. The scenarios, price targets, and trading strategies discussed here carry significant risk, including the risk of total loss of capital. Always conduct your own due diligence. Consult a licensed financial professional before making any investment decisions, and never invest more than you can afford to lose. Past price performance is never a guarantee of future results. Markets can and do behave in ways that no analysis can perfectly predict. So here is the final verdict from Smart Stock Sam. SanDisk Corporation is no longer the company that made the little flash drive you bought at an airport gift shop. It has transformed into what could genuinely be called the foundational bedrock of the global artificial intelligence infrastructure supercycle. The $42 billion fixed contract backlog, the 78.4% gross margins, and the massive institutional ownership tell a story of a company operating at an entirely different level than anything it has ever been before. But the insider selling, the extreme put-to-call ratio, the aggressive dark pool shorting, and the macroeconomic contagion from OpenAI IPO, delays, and Asian tech market panic tell a parallel story of serious near-term risk. This is not a stock for the faint of heart. If you have the conviction, the risk tolerance, and the discipline to respect those critical support levels we laid out today, this pullback could represent a genuinely compelling entry point on the path back toward $2,500. But if the stock loses that $1,773 200-day moving average, you step aside and wait. Now, here is the question I want you to answer in the comments right now, and I genuinely want to hear your thinking. Given the 6,500% rally already on the books and the $42 billion contract backlog still ahead, do you believe SanDisk's new business model has permanently broken the memory chip cycle? Or is this the kind of story that only makes complete sense in hindsight after it has already crashed? Drop your answer below, because the conversation that happens in the comments is just as valuable as the video itself, and I read every single reply. If this breakdown gave you something you could not find anywhere else today, do two things for me right now. Hit that like button. It takes 1 second, and it helps this channel reach more serious investors who deserve better analysis than what the mainstream financial media is giving them. And if you are not subscribed yet, join the Smart Stock Sam family right now so you never miss a deep dive like this one. And one more thing before you go. If you want to take your investing and trading to a completely different level, the Smart Stock Sam membership community is open and growing fast. Members get early access to trade setups before they go public, priority replies when you drop questions, and the ability to request custom analysis on any stock you are watching directly from me. This is the closest thing to having an institutional research desk in your corner. The link to join is right below this video. Come level up inside the community. And if this video delivered real value for you today, you can also support this channel directly through YouTube's Super Thanks feature. Every contribution keeps this independent, honest analysis going without any corporate agenda attached to it. I will see you in the next one.